is taxation and regulations for purchase, holding, and sale of immovable properties in India. This is a topic which we understand is very much close to the need of so many of the non-residents, because non-residents Indians have got their roots in India. They would like to buy properties, real estate in India. They would like to hold real estate in India. And obviously, because of their roots in India, they would also inherit real estate in India. So these transactions in respect of real estate are very common and very much required. To start with, what are the broad provisions in respect of purchase of real estate? The broad provisions in respect of purchase of real estate are that non-resident Indians, all non-resident Indians, except non-residents of certain jurisdictions like Pakistan, Bangladesh, Nepal, those kinds of countries, there are certain restrictions where they cannot buy real estate in India without the prior approval of the Reserve Bank of India. Otherwise, all the non-resident Indians can buy land, building, apartments, any kind of real estate and any number of real estate, whatever they desire. There are no restrictions for non-resident Indians to buy only a certain number of real estates. They can buy any number of real estates in India. They can hold 10 apartments, 10 pieces of land, 10 buildings, whatever it might be. It's a general permission. But what they need to definitely take into consideration and be a little watchful about is that trading in real estate or business of real estate, which is buying and selling of real estate, is something which is banned or not allowed for non-resident Indians. But out there also, a non-resident Indian can indulge into a business of construction and development of real estate, and he can very well do it in any format, in the proprietorship format, in a partnership format, in an LLP kind of a format. They can definitely go for construction and development of real estate. But even in those kinds of formats, what is important is something which they cannot do is that they cannot indulge into buying and selling of real estate, which is a business or a trading of real estate. Then they cannot buy agricultural land in India. They can inherit agricultural land, they can hold agricultural land, but they cannot buy agricultural land in India after they turn to be non-residents under FEMA. For these purposes, which whatever I'm talking of, my reference would be somebody who is a non-resident under FEMA. So the moment somebody is a non-resident under FEMA, they cannot buy agricultural land in India. They can only inherit, or they can continue holding it the time from which they were residents. The account from which these lands could be, or these real estates can be purchased, is either from an NRO account, NRE account, or by way of remittance. So if a real estate is purchased out of an NRO account, obviously the proceeds of that account, the sale proceeds, will go to the NRO account, obviously. Even in case where the real estate has been purchased out of a NRE account or a NRO account, or by way of some remittance from abroad, the remittance would, in the first place, the sale proceeds in the first place would go to the NRO account. But if the original purchase in respect of residential house was made from an NRE account or by way of a remittance to the extent of 2 residential houses, those amounts of the sale consideration, whatever be it in respect of those 2 residential houses which were purchased from an NRE account or by way of remittance, can be freely repatriated abroad after payment of appropriate taxes in India. Then we go to the next part of the topic today, which is holding of real estate. Real estate can be held by non-resident Indians very freely without any restrictions. The only thing which I discussed was in respect of agricultural land, where they can hold and receive by transmission, but they cannot buy fresh real estate. Even when somebody turns to be a non-resident, there are so many times we receive questions that now I am a non-resident, can I hold the real estate which I was holding earlier? Yes, you can hold those real estates. Whether you can receive real estate by way of transmission, that is by way of inheritance from somebody who was a resident in India, yes, you can definitely receive those real estate by way of transmission. There is no problem. The restriction is only in respect of certain jurisdictions, or rather nationals of certain jurisdictions, which is Pakistan, Bangladesh, Nepal, and those kinds of countries. Otherwise, real estate can be freely held by non-resident Indians. Now, the third leg of our discussion is sale of real estate. Sale of real estate can definitely be done, obviously, by a non-resident Indian, and the sale proceeds would go to the NRO account. From the sale proceeds, whosoever is the buyer of this real estate from a non-resident Indian is supposed to make deduction under Section 195 of the Income Tax Act and is supposed to deduct tax at the maximum rate on the entire consideration. The only way out is that one should go for availing a certificate from the Income Tax Department for lower tax deduction on the basis of the actual amount of tax incidence which would be on a particular transaction, giving the effect of the purchase amount, which is something which is deductible. On the top of it, one can claim deductions on the indexation, and that amount is the amount on which a certificate can be obtained and TDS has to be made. But that is only after we have received a certificate from the Income Tax Department about the lower tax deduction. Otherwise, the entire consideration is supposed to be offered for tax deduction at source. There are some conflicting views on this matter. There are some decisions or some interpretations by some councils that tax deduction at source has to be made only on the capital gain element, but there are several decisions which are against that view, and the view that our office holds is that either one has to make a deduction on the entire consideration which is to be received by the non-resident Indian, or one should obtain a lower tax deduction certificate. A non-resident Indian can also claim deductions under Section 54 EC by investing into capital gain bonds and also investing into another residential house out of the capital gains which has accrued or arisen from India. As far as capital gains on sale of agricultural land is concerned, the the taxation would be in the manner that if that agricultural land is situated within the specified limits nearby to a town or a city which has been specified under the Income Tax Act, if the aerial distance of the land which is sold, which is agricultural land which is sold, is within those limits, then that income arising from that land is taxable. But if the land is beyond those limits which are specified, the income or the gain arising from that transaction on the sale of agricultural land which is situated beyond those specified limits is not liable to tax at all. One thing I would like to clarify here is that even if a non-resident Indian invests in, say, 54 EC bonds or purchases another residential house, those deductions are deductions which are limited to India. Insofar as offering that income on sale of agricultural land or maybe or any kind of real estate for that matter, those incomes would be liable to taxation in the country where that non-resident is a tax resident of. So, for instance, if I am selling my agricultural land which is situated beyond a certain limit from the city, which is beyond that limit, as I said, it is tax-free. But that tax-free status is in India. If I sell an apartment and I invest in 54 EC bonds to the extent of 50 lakhs of rupees, I will get a tax break in India. But these incomes, if I am a US tax resident, these incomes have to be offered for tax in USA and I will have to pay taxes. If if I am paying taxes in India on the transaction of sale of any kind of assets for that matter, not just agricultural land, if I am paying tax on the transaction in India, I will get a set off of those taxes when I am filing my tax returns in say US, in the instant case which I am talking of. So a deduction which is in the nature of an exemption, that this income would not be taxed in these circumstances, would be limited to India, and it would not get a benefit when it comes to its taxability, which is outside of India. So with this broad basic discussion, I will open the house for question answers. Anybody who is intending to raise a question, they can press the button of raise your hands and our office will unmute you so you can speak out that question and I will address and answer that question. If somebody is not comfortable asking a question in the mode of the way I said, where they would prefer to write that question, they can write that question in the chat box and our office will read it for me and put that question to me and I will answer it, which you can obviously hear it. Thank you. With these words, I will open the house for questions.
Yes, good morning, Daxesh bhai. Good to see you in the second session. There is a question from Feroz bhai. He's from Canada, and I think he is asking for a person being a tax resident of Canada, how he can take the benefit of double tax avoidance agreement (DTAA) that has been done between India and Canada. So, what are the benefits, and how he can take the how he can avail the benefits, those benefits?
Right. So the way it would exactly operate is that, say, you are disposing your real estate in India. When you are disposing your real estate in India, you would be liable to taxation in India because that income has arisen from India. So when you are paying taxes in India, those taxes would be available as a set off when you are filing your tax returns in Canada, where you need to show this income as an income which has accrued outside of Canada. Because as you are a tax resident of Canada, you are supposed to pay tax on your global income, the Canadian income and the income which is arising outside of Canada as well. So you need to sum up that entire income, the Canadian income and the Indian income, which is on that capital gains, and on the tax liability which is arising in Canada on that entire income, you will get a set off under the double taxation avoidance agreement between India and Canada of whatever taxes that have been paid in India.
Okay, I hope Feroz Bhai might have got his answer. One question is that as you told that the NRIs can invest in property in India, are there any limits of holding number of properties like commercial and residents?
No, there are no limits in holding number of properties, may it be commercial or residential, but the activity should not be, or it should not draw an inference from the activity that this is like a trading or a business in real estate that a non-resident is doing. So if I am buying, say, 10 offices and keeping it for at least a few months or a good number of years or good number of months, and then disposing off, it is okay. But if I buy and sell, if I borrow capital, invest the way a businessman would do, a trader would do, if that kind of a transaction in real estate is done by a non-resident Indian, then that is not something which is allowable under the Indian regulations.
Okay, this means that you can't do business of reality. You can't do reality business here in India. Okay, okay. And how, like, what will be the tax effect if an NRI is having more than 2 properties here in India?
As far as the income is concerned on the year-on-year basis, in India, under the income from house property, if somebody is holding more than 2 immovable properties, which are in the nature of a property which is liable for being considered as an income from house property, then in respect of properties which are beyond 2 real estates, notional income in respect of those assets have to be offered to tax while filing the tax returns in India.
Okay.
For 2 residential houses, there is you can hold those residential houses as if they are self-occupied. Beyond that, whatever are the real estates which are held, they have to be offered for tax on the rental income which that property would yield on a notional basis and has to be offered for tax.
Okay. Okay, fine. If let's continue the same example, the same question, the scenario, and if the person is NRI is having three properties here in India, and he's paying taxes on the notional basis, does he has to declare that thing to his home country's tax authorities?
No, this is a notional provision. There is no income which is as such accruing or arising in India, or it is a real income. So in my understanding, one has to definitely refer to the local law where he is subjected to taxation. But my understanding would say that those incomes which is actually not arisen, this is a notional taxation of income, and that will not lead to taxation in their home jurisdiction.
Okay, okay, fine. That's why one more thing that as you were telling that NRI can apply for a lower TDS certificate before he wants to sell his property here in India, so that he can get the actual rate which apply to considering to the tax liability on that sale proceed. So how many days it takes to apply for a lower TDS certificate, and who can really help us in this matter, like a chartered accountant or any consultant?
Right. The first thing that the moment somebody strikes a deal with the buyer, there would be an agreement to sell, which would be executed or which has to be executed, which would mention everything in respect of the transaction, that this person is the buyer, this person is the seller, this is the amount at which the property is supposed to be transacted, and on the basis of that, the entire process would get kick-started. One can avail the services of a chartered accountant or a tax expert, or one can file these things online. No personal appearance is required. One can make this application online if somebody is conversant, well-versed with the Indian tax laws, and they can file that application. And on a rough reckoning, I would say that because at times the tax authorities have some questions back and forth. So maybe 1 month is a time which I understand would be quite sufficient to obtain that lower tax deduction certificate.
Hello.
Hello.
Hello. Hi, Daxesh sir. This is 𝗧𝗔𝗕𝗥𝗧𝗓 from Canada. I hope you are good.
Great, great.
Yeah. So my question is, you mentioned that once I sell my property in India, and from the capital gains that I get from that real estate, I can invest in a house, like buying a house, or I can buy investment bonds, right? So is there any limit, like after how much time I can, like until once I get my capital gains, in how many years I have to, first question is in how many years I have to buy a house, and what is the limit, like what is the amount limit on buying bonds as well as house, if there is any?
Perfect. The first part of the question, 𝗧𝗧𝗫𝗓, is in respect of, say, if I have a capital gain arising on a transfer of a real estate in India, say if I want to invest into capital gain bonds, right? So if I'm intending to invest into capital gain bonds, then the cap is 50 lakhs of rupees. The maximum investment that somebody can make is 50 lakhs, and that is the capital gain amount. So my out of the sale consideration, there would be a deduction which would be made in respect of the cost price and the indexed cost price. That is the indexation on it. Thereafter, whatever is the capital gain, from that you can make an investment into those bonds to the extent of 50 lakhs of rupees. And that has to be made within 6 months from the date of transfer of the capital asset from which the capital gains has arisen. So that is in respect of investment in capital gain bonds.
Okay.
Another deduction which we can claim is that I am disposing a real estate. Say if I am disposing a residential house, then if I am disposing a residential house or I'm selling a residential house in India, then I just need to invest the capital gain component in that transaction of the sold residential house into another residential house, and that can be 1 year before the actual sale from which the capital gain took place and 2 years after. So the transfer of the asset on which capital gain is arising is today. Today I executed a document and the capital gain is arising today. But even if I have bought a residential house 1 year before to today, it would be eligible for deduction. And if I want to buy a residential house, or if I intend to buy a residential house 2 years from today, today is the date of transfer, from 2 years after and 1 year before, in both these situations, that deduction is available. But if I am planning to construct a residential house, obviously construction of a residential house, I would need to buy a land, then execute the process of construction, everything. There the limit is 1 year before and 3 years after. So I get a long period of time through which I can execute and claim this deduction. But one thing which everybody should be mindful is that if in case, say this 2 years or 3 years, time is still pending, but if the due date of filing of the tax return in respect of that transaction falls within this period of this 2 years and 3 years, which would obviously fall, say if there is a transaction of sale which is taking place today, and if I don't have any business income, then I will have to file my tax return on July 2021. And I need to either pay my capital gains when I'm filing my tax returns, or what I need to do is that I need to deposit that amount into a designated bank account in India, which is called a capital gain account scheme account, wherein whatever is the amount which I am planning to invest in buying of a residential house, and because I have got the time of 2 years from now or the time of 3 years, but in between I will have to deposit in a designated account, and all payments thereafter would be made from that designated account by the bank to the seller of the real estate or other residential house which you are planning to buy. So this is all that you need to take into consideration or take care of when somebody wants to claim this deduction.
Okay. Okay. Yeah. Thank you very much. Thank you.
Hello. Can you hear me?
Yeah, very much. Please.
I'm Dr. Janesh, and I am here at Houston, USA. And my question is, I have my official funds in India invested in PPF, fixed deposits, unit trust, and all the officials. My tax paid money I have invested there, which I would like to transfer here in US. What will be the tax implication here in US? I can directly transfer them without that implication. What will be the way I should be doing it?
Okay. As far as the entire transaction, the way it would go is that whatever are the deposits that you are having with, say, a PPF or any investments into Unit Trust of India, as you said, those entire amounts would land up into your NRO account in India in the first place, right?
Okay.
So you should map up, or you should give banking details of your NRO account to Unit Trust of India and to PPF and all the investments wherever you have made those investments, because now you are no more an Indian tax resident, right? So the first thing that we should be doing is, as I said, that map your NRO account, non-resident ordinary account, with those investments. Then the moment those investments get matured or you redeem those investments, the funds would get transferred into the NRO account. From the NRO account, you can remit those funds directly outside of India under the $1 million scheme, wherein to the extent of $1 million per person per year, a non-resident Indian can remit tax paid money outside of India with a small formality where you need to upload a form certified by a chartered accountant, and that is all that you do. You do not require any approval of permission from anybody, and those monies can straight away travel outside of India without any difficulties. Now, when it comes to its taxability and that part in US, our advice, because we are practicing and professing in India on income tax and FEMA, it would be appropriate for you to seek legal counsel in US. But of whatever understanding and whatever I have learned from my interactions with my clients in US is that what is important is that you have become a US tax resident since a little time, because these investments were in India. So anybody who is a US tax resident, that tax resident has to disclose his global income in US when they are filing their taxes or paying their taxes in the US. So along with the US income, if these incomes, which were howsoever big or small, that were arising from either the PPF account, that PPF account might be tax-free in India, but that PPF interest is taxable in US. So whatever is the interest, whatever is the dividends or any gains that you have been receiving on the UTI investments as well, that entire money, if they are declared over a period of time in due course in US, in my understanding, it should not be a problem to pay taxes once again in US for the incomes and the assets which have already been declared in US while filing the US tax returns.
Okay. Okay. Thank you, sir. Thank you. Nice of you. Thank you. Thank you.
Hello.
Yeah.
Good morning, sir. So my question is how we can repatriate the proceeds from the property to abroad, and is there any limits for repatriating the funds received from the sale of immovable property?
Okay. As I was talking in the initial discussion, that if immovable assets, being residential house, which are purchased out of repatriable funds, right? So if somebody has bought a immovable asset being a residential house from the NRE account or by way of remittance, to the extent of 2 residential houses without any limits, those proceeds of those 2 residential houses can be remitted outside of India without any difficulties straight away, right? But if I am holding real estates which are other than residential houses, say I am holding plots of land which I have received by way of transmission, by way of inheritance, or by whatever reason, or I have bought some other real estates, then the proceeds on the sale of those real estates or those immovable properties would go into the NRO account. From the NRO account, if appropriate, or rather the moment I pay those appropriate taxes on that transaction, to the extent of $1 million per person per year, the proceeds of those property sale can be transferred outside of India seamlessly. And I repeat that it is $1 million per person per year. So if I am selling a property worth 10 crores of rupees today, $1 million on a rough reckoning would be 7 crores and 30 lakhs odd amount this year. So what I can do is that this year, that limit of 7 crores 30 lakhs I will utilize, or I can utilize and transfer the money to that extent. And in the next year, which is starting from 1st of April, once again, I can avail that limit and transfer that balance amount outside of India. And that is the way practically I will be able to transfer the entire sale consideration outside of India.
Okay, thank you, sir.
Daxesh bhai, one quick question from my side. Say, for example, we have sold a property here in India. NRI has sold the property, and there is a loss from the property disposals. So, can an NRI get the set off of that loss while he files his income tax return here in India? And further to add in this question is that for how many years that loss can be carried forward if we are getting that set off, if we can carry forward the loss, and what are the options in which we can adjust that loss from property disposal? Yeah.
The first part of the question is that whether that loss can be carried forward or not. Yes, that loss can be definitely be carried forward while taking into consideration the taxability aspect in the subsequent years. But that would be limited to India, because in India, the way the calculation insofar as taxation of capital assets is concerned, over and above the cost price, that cost price is subjected to indexation, which is the inflation component on the cost price, and an indexed cost price is determined. So if I had bought a property to say worth say 1 crore of rupees, and I was holding it for a period anything more than 2 years, then whatever was the inflation component across that period of maybe say 5 years of my holding, that would change my cost price from 1 crore to that 1 crore and 17 lakhs and odd, or whatever be it, depending upon the inflation which has taken place across that period of that 5 years of my holding. So if I'm selling that property for 1 crore and 15 lakhs, effectively I am making a gain. But under the income tax law, I am making a loss. So that loss which I am making under the income tax calculation is also subject to it being carried forward for 8 consequent years after the year in which the loss has arisen, and that capital loss will be set off against only capital gains which are arising in the subsequent years.
Okay. Means one can invest in even equity shares, even equity oriented mutual funds where they can get the capital gains or loss. Okay. Okay. Thank you.
Hello there, can you hear me?
Sure.
Yes, okay. How the inheritance property sale is taxable or not taxable in India? For example, like I inherit the property from my parents, and if I sell that, how it is handled?
Okay. I will explain the entire process in which it would be taxed. The moment you are selling an immovable property in India, there is a sale consideration, the amount for which that property is sold. Out of that, you will get a deduction of the cost price, right? So the moment you look at the cost price, you would start thinking that I didn't pay anything because that was something which I inherited from my parents or from anybody in the family. So then the principle which is applicable is that whatever is the cost of the previous owner from whom you inherited that property. Now, if that property is a property which is purchased before 1/4/2001, say it was purchased in 1957, just like that, or maybe in 1984, then all those costs have to be completely ignored. And the value of that property as on 1/4/2001 becomes your deemed cost price. So you need not look as to what was the cost that my father incurred while he was making this residential house. I have not to look into it. And it will be the value as on 1/4/2001. Now, in order to determine what is the value as on 1/4/2001, India has got a system wherein every property is valued or can be valued on the basis of a government published reckoner, that this plot of land or this residential house can be valued on the basis of its location and on the basis of the age of construction in a certain manner. So it is one value that anybody can find out that this is the value as per the government records and government system. So that is the value which will be your deemed cost price as on 1/4/2001. After that, as I was talking to the earlier querist, what we have to do is that whatever is the inflation which has occurred from 1/4/2001 till the date of disposal, say in 2021, all these 21 years of inflation will be added to that cost price. And there are indexes which are readily available. So it's a 1-minute exercise. So on that 1/4/2001, say the value as on 1/4/2001 is say 5 lakhs of rupees. That 5 lakhs over a period of this 21 years would become say 15 lakhs 50,000. So 15 lakhs 50,000 is the amount which you will get as a deduction from your sale consideration, and the balance amount would be the capital gains.
Okay, how it is handled if the property is the sale of the property is divided among the siblings?
So then whatever calculation that we have arrived at is in respect of the entire property. So whatever is the proportionate share of each of the sibling is something which is liable to taxation in the hands of that respective sibling. So my share in the entire joint property is say 17%. So I will be supposed to do that compliance of payment of taxation and liability for compliance and everything only to the 17% of the total value of the property.
And how much tax is there on the capital gain?
Okay. The capital gain, whatever is arising out of this entire transaction in the methodology which I said, is a 20% plus surcharge plus cess. So there are surcharges and cesses which are levied beyond that 20%. That is a flat rate of tax which is payable on any capital gains transactions which happens in India on the real estate side. And of whatever deductions which I was talking earlier, I always said that those deductions are the deductions which are centric to India. So if somebody is compliant as far as, or is in a jurisdiction where they have to pay taxes in their in the country in which they are the tax residents, then payment of taxes in India on that capital gain is something which is worthwhile. And whatever is the amount which is subjected to taxation in the country of residence, on that you will get a set off of whatever taxes that have been paid in India.
Okay, now this is another question about the, suppose I sell some stocks and I incur a loss in there, how that is handled?
If you incur a loss, then if you have got any capital gains in that year, then it would be set off or it would be carried forward.
How long it is carried forward?
Sorry?
How long will it be carried forward?
8 years.
8 years, I see. Okay. All right, that answers the question. Thank you.
Okay, Daxesh bhai, there is a question in our YouTube channel by Mr. 𝗧𝗔𝗬𝗓𝗓, and he is asking that me and my wife both are Canadian citizens, but living in India since 2017, and we are earning in India. We have PPF account in India, and that is getting matured in soon, very soon. So can we transfer the earnings, the earning money that we are getting in India and all those PPF maturity to Canada? Okay. Despite they are the Canadian citizen, they are living here in India since 2017, still they want to transfer that fund to Canada.
Okay, fine. The first and foremost thing which we need to take into consideration in this entire issue which we are trying to discuss is that what is the tax residential status and the residential status under the Foreign Exchange Management Act. Right? So when it comes to the investment part and the remittance part, the residential status under the Foreign Exchange Management Act is the status that we need to take into consideration. So now in this instant case, Tejas Bhai is a person who is holding a Canadian citizenship, but he is staying in India. So under FEMA, if somebody is staying in India and wants to be in India for an uncertain period of time, or is carrying out any business, profession, vocation in India, irrespective of the fact that he is holding a Canadian passport, he is an Indian tax resident, and also an Indian resident under FEMA. So the moment he is an Indian resident under FEMA, then he can very well hold PPF accounts, and the provisions which are applicable to him would be that the proceeds of that PPF account will be credited to his resident Indian account. I repeat, irrespective of the fact that he has got a Canadian passport, and from that account, to the extent of $250,000 US under the liberalized remittance scheme, which is applicable to residents under FEMA, he can remit that money outside of India in whatever manner, by way of investments, a gift to some some family members who are outside of India, he can make those remittances under the liberalized remittance scheme.
Okay. So in continuing with that question, Tejas Bhai is having another question. Person is a resident Indian or an NRI, whether they can open a PPF account in India, like what regulations say about that?
The only aspect one needs to take into consideration is that if somebody wants to open a PPF account in India, he has to be a resident under FEMA. And under FEMA, tax residency and the whatever is the status under the citizenship law doesn't matter. That person has to be in India for an uncertain period of time, carrying out any business, profession, vocation in India. That is a base which is enough, or that makes him a resident under FEMA, and that person can open a PPF account in India. As far as holding a PPF account, somebody who becomes a non-resident, say my son, he was a resident all these years, but now he is outside of India, he can continue holding that PPF account till its maturity and deposits its every yearly the deposition to the extent of say even 1,50,000 on a year-on-year basis. But he cannot renew that account after that account has matured.
Okay, Daxesh bhai, one quick question is, if an NRI has received agricultural land by way of gift, so if is generating the income from that, regular income from that agri land, so will it be taxed here in India? And what type of tax levy would apply on that income?
As such, one cannot receive any agricultural land by way of gift, nor they can buy it. The only way they can receive, or rather they can hold, is either they continue holding the land which they were holding at the time when they become non-residents, or they can inherit agricultural land. Say my father, out of his share, whatever was in the big piece of agricultural land, I received, say, a share in it. That is okay. And whatever is the income which is arising on that agricultural land would be tax-free in India, because agricultural income is not liable to taxation in India, but it would be liable to taxation in the jurisdiction where somebody is a resident and his global income is supposed to be taxed in that jurisdiction.
Okay. Sir, one question in the chat is from Mr. G. Patel. He's asking that how to transfer amount received from fixed deposits, saving bank balance, and shares to US.
Okay. I understand that person is now a non-resident Indian. If he is a resident Indian, then he can transfer that money under the liberalized remittance scheme to the extent of $250,000 per person per year. But if that person is now, of what I infer from the question is that these were the investments which were made at the time when he was a resident Indian, and now those investments are maturing. So what we should be doing is that transfer the proceeds of all those investments into the non-resident ordinary account in India, NRO account, and under the $1 million per person per year scheme, those amounts can be transferred outside of India. Appropriate taxes have to be paid on whatever are the proceeds which are credited into the NRO account, and it can be freely transferred.
Okay. Just one last question from my side that is related to like if an NRI is not applying for lower TDS certificate before he is planning to sell off his property here in India. So if it is not applying for the lower TDS certificate, then how much time it would take to get the refunds back from Income Tax Department? and naturally buyer will deduct the TDS and then pay the balance amount to the NRI.
The entire transaction, the way it would happen is that during the year, say starting from the 1st of April to 31st of March, which is the tax year in India. So if whatever is the date on which I transfer my property and my taxes have been deducted, I will be filing my tax returns. If I don't have any business income, I will be filing by 31st of July, right? So by 31st of July, I'll be making a claim to the income tax department that a certain amount of money is due to me by way of a refund on the basis of the calculation which I'm submitting in my tax returns. So thereafter, the processing of my return would start. So the moment that return gets processed, then we would receive the refund directly as a credit in the bank account. And if our submissions, our filings are in a proper order, there is no reason to believe or fear that my return would be withheld. And on a rough reckoning, in a time of 6 to 8 months after the date from which the return is filed, one should be receiving the refund in the bank account directly by way of credit. And in India now, for the benefit of all the non-resident Indians and for everybody in India, not just non-resident Indians, India has now an absolutely faceless assessment procedure for income tax. One need not visit any office or meet any officer. Everything, filing, processing, and everything is absolutely faceless. And there is no reason to fear that I would be unduly harassed or troubled by anybody.
Okay. Sir, one question from Mr. 𝗥𝗘𝗚𝗎𝗓𝗓 on our YouTube channel. He's asking that I'm a resident in Africa and I want to give amounts to my mother in India. So what is the tax implication and what are the limits that would apply?
Gifting any amount of money to your mother, there are no restrictions whatsoever. The amount which we are transferring by way of gift should be earned and one should be able to explain as an income which has been earned outside of India in an orderly manner. And if those amounts are gifted to mother, looking to the relationship of son and mother, any amounts credited in mother's account are completely tax-free, howsoever big or small they might be. There is no bar, no restrictions, and monies can be received. I repeat that those amounts should be explainable. If amounts are unduly high, which are not in sync with the activities of somebody outside of India or cannot be explained, those things might be something which might be questioned by the Indian tax authorities only if they are of that nature. Otherwise, whatever be the amount, they are as such absolutely tax-free and allowable.
Okay. Sir, one question from Tejas Patel. As I asked before that they are holding the Canadian citizen and they are living in India since 2017. So they both are doctor and their PPF has just got matured. But now they need to open another PPF that we had discussed that they can under FEMA if they are a resident Indian. But can they buy the agricultural land despite they are holding the citizenship of Canada here in India?
All the discussion which I was talking in respect of real estate and investment and everything, the pertinent thing to be noted is what is the status of a person under the Foreign Exchange Management Act. So holding a citizenship or not holding a citizenship would not deter or debar anybody from transacting into agricultural land. The definition which would be applicable to buying an agricultural land would be a definition under FEMA. And as I said, under FEMA, you are a Indian resident under FEMA. So there is no bar, no difficulty in buying any agricultural land in India. Conversely speaking, say if I am in the Middle East and I don't have a citizenship of that country, which is obviously not available to most of the people, even if they are there in the Middle East since 2 generations, they don't get a citizenship in those countries. But still, they are non-resident Indians because they have left India to take up any employment, any business, vocation, or to stay outside India for an uncertain period. They become non-residents and they cannot buy agricultural lands in India. So what is the pertinent thing is, what is your status under FEMA? That is something which we need to take into consideration.
Okay, sir. Thank you.
Now we'll take up the last question, and the balance things we'll keep for the next weekend. We'll take up the last question from Mr. Dr. Joshi.
Hello, sir. Good morning. My question is, what is the upper limit of gifts that Indian resident can give to the children who are non-residents?
Okay. As such, there is no upper limit for the residents to give to their non-resident children. And these definitions and everything, I am talking under FEMA. So if somebody who is holding an Indian passport, but he is very much in US, he is not a US citizen, that person under FEMA becomes a non-resident as such. Now let us, for that, there is no limit because both are non-residents. Both of them are non-residents. But take a case where I am very much in India. My son is in US. Then the limit, the way it would work is that as such under the Income Tax Act, there is no limit. I can gift any amount of money, but under the exchange control regulation, I can send money or gift money to the extent of $250,000 per year. So that is the limit which would apply under the exchange control regulation. Under the income tax, as I said and I repeat, there is no limit whatsoever.
Thank you, sir. So nice of you. Thank you.
At this juncture, I would like to thank everybody for participating in this Q&A session. We'll be organizing these kinds of this session every weekend. Everybody is welcome. We'll discuss out. We'll talk in brief the way we did this week. I will talk for 10-15 minutes at the outset, and the house will be open for question and answer. Everybody, all your friends, relatives, they are most welcome. They can join and we'll discuss and we'll try to solve all your queries relating to that topic, maybe even not relating to the topic, and which is close to the heart of all the non-resident Indians. Thank you very much. Thanks for participating in the show. Thank you.